Hello everyone, welcome back. Today we're going to be giving a quick update on several of the key economic data and charts that we have been walking through over the last several weeks and months. And an interesting thing has been developing, so I wanted to kind of share that with you and specifically what I'm seeing here. And, it appears as though stocks are defying the economic data that we keep getting in. So let's take a look at exactly what's been going on with regards to both the price action as well as the data. And so the first chart that I wanted to start off with is the most important chart in my view, just because this provides the backdrop, and the key difference between the past 10 years and what we have today. We've had almost 12 years of consecutive easy money policy from the Fed. And so what has happened is every single dip has been bought because of, continuing accommodation from the Fed in the form of very low interest rates, in the form of quantitative easing in its various forms. And for the first time ever on record, M2 is now officially dropped below zero. And that's never happened in more than 60 years since we've been tracking M2. So this is a first, thing that we're seeing here that, no economist has ever seen, at least in their lifetimes. And what this is basically showing is that it's a simple mean reversion play. So the green line right here represents the growth year over year of the M2 money stock. And it's now below zero. And the blue line represents the actual aggregate M2 money stock. And you can see what happened as in response to COVID. We had, the most exceptional, monetary response that took M2 soaring way beyond its long-term trajectory of growth. So what I'm expecting here is a simple mean reversion, back to what, M2 has been historically growing at over the past 60 years. So if we were to take a look at that, that would take us to roughly 17 trillion, I should say, in terms of the M2 money stock. And we're currently at 21.3 trillion. So this has quite a ways to go. And all I'm saying is that I think mean reversion is in play. So we're going to see this number stay below zero for the next year, possibly even 2 years. Where, as the Fed takes us back to a more normal sort of monetary policy. And this is one of the reasons why we've had, high inflation too. Demand has exceeded supply for quite a while, ever since the COVID pandemic started. And the Fed is now committed to removing that liquidity. So for the first time ever, we have a difference in liquidity. Liquidity is what has held multiples high for a very long time. And now that's being removed by the Fed. So this is, providing to me some level of caution, because the Fed is very clearly telegraphing that it wants to bring stocks down. It wants to bring multiples down. They don't say that in that specific language, but that's what they ultimately want to do, because this is what's partially fueling inflation. We have the wealth effect. We have stocks trading at high multiples well above long-term averages across the board in virtually every sector. And so the Fed is fighting inflation by removing liquidity, and that to me is a bearish signal on where multiples are going for equities across the board. With regards to the CPI, this is a chart we've been looking at, and ISM backlog ticked up a little bit in December, but still well below 50, which means that it's still contracting. I expect the CPI to come down substantially. I think, just like what we saw in the previous chart, I think CPI needs some mean reversion too. So I would not be surprised if we get CPI below zero. That was my call that I made in the last video about 2 weeks ago. And I'm sticking by that. I think the backlog has a very, very positive correlation with the CPI, and that's basically telegraphing that CPI is about to roll over, and it now is. You can see that the backlog started to move down well in advance of the CPI moving down. That's about a 6-month lead time. So, as long as the backlog remains below 50, I think that this number is going to continue to come down like it has, hitting a high watermark of 9.1%, and now it's down to 6.5. I won't be surprised to see this down to 5% by the spring, and back below 3% by late summer or early fall, and then possibly even negative by the end of the year. So we will see where that goes. But as long as this number remains in contraction, which it is, this is very, very bearish for CPI. Now the question is what's causing that, right? So there's always a question as to why the backlog is coming down. There's a good reason for it to come down and a bad reason. The good reason would be that production is picking up significantly, that factories are ramping, that labor is abundant, and manufacturers are clicking on all cylinders, and supply chain bottlenecks have been completely resolved, and the economy is humming along quite well. That would be a good reason for backlog coming down. But the bad reason for it to come down is on the demand side. If there is weakness in demand, then given a steady state rate of production, that would lead to a clearing of backlog. And that's what I think exactly what's happening. Many demand side leading indicators are starting to roll over. This was one of the reasons why I was bullish early last year, 2021. If you go back to those videos, I remember very clearly saying that these numbers are looking good. So as long as that stays as is, the threat of recession will remain at bay. But look what's been happening now. This is the new orders index. This is the measure of orders for durable goods. And that's, coming down quite, substantially here from the levels that it seemed to be, steady at, which was right around 6% or so. Now it's basically flat year over year, and the rate of change is negative. You can see the same thing with factory orders, another way of looking at the demand side. And you can see that number has been rolling over. This was at 7% consistently for almost an entire year, from mid 2021 to mid 2022. That was a great stretch of expansion. And now, it's falling, very, very close to contraction. This number should stabilize right around, you can see in the past during bull market years, it's stabilized somewhere in that 5% range, give or take a few percent in any given month. But, it averaged out to a median of about 5%. That would be a good number to maintain, for a healthy bull market. But now we're well below 2%, and the rate of change continues to be negative here. So these are two numbers that I would keep an eye on, but you can see that there is very clear evidence that there is softness in demand. This is a more of a specific look within that new orders index. It's been in contraction now for 2 straight months, and I believe actually it's going to be 3 months now that this number has been in contraction. So again, weakness in demand. Here's the other index that I'm watching here. This is the leading economic index, and that continues to plunge. You can see where that level is at. Excuse me. This is published by the Conference Board, and this number is well below average levels that is consistent with the recession. This is their commentary right here. They themselves write that the trajectory of the U.S. LEI continues to signal a recession. So again, these are leading economic indicators, things like initial claims, building permits, factory orders, other things like that. These are all indicators that are known to turn ahead of the business cycle, in the past at least. And those same indicators have significantly rolled over. This index has now been down for 10 consecutive months now. You can see that right here. It used to be expansionary, but the rate of change has been negative for 10 consecutive months. And now it's in contraction officially. So these are not good trends, folks. I don't want to look like I'm biased here, but I'm just looking at the data and the economic data points. Unless if this magically rebounds here, I don't see why we would be buying stocks at this level. You can see again, one of the contributing factors to inflation was the used car prices. This thing soared. And it's now finally coming back. Again, talking about mean reversion. I think that this will come back to mean reversion. You can see that this should come back to levels of, between let's call it 175. That number should be heading down, and it started to head down. It did tick up in the most recent month here in January. But I think the overall trend is down. So this should, be mean reverting. So again, what does this mean? When prices revert to the mean, it means that profit margins would start to get hit for companies across the board. That's what typically happens in recession. When demand drops, prices come down, profit margins get hit. Companies operate at well below capacity. That leads to negative operating leverage and therefore a drop in earnings. And this is exactly what the Chicago PMI is saying right here. Again, this indicator has had a remarkable correlation to S&P earnings, and it's been in contraction now for 4 consecutive months. And so if this continues, I think that this is a very strong case to be made that the S&P's earnings for this year, fiscal year 2023, will come in below 2022. So we're talking about a contraction in earnings for the S&P. I think that's almost guaranteed. I wouldn't say guaranteed, but the longer this number stays below 50, the case builds. So if we get another 2 months, maybe, once we get January and February numbers in, if it continues to stay below 50, I think the case is rock solid that earnings will contract this year versus last year. And that would be consistent again with what happens during recessions. You can see what happened here in 2008, 2009, as well as what happened in late 1999, 2000. That also was another period of deep contraction and therefore an earnings hit for companies across the board. And that's exactly what's happening here again. So it actually plunged, to about 42 reading, which was the lowest that we've ever seen since the Great Financial Crisis, again, if we were to ignore the COVID period here. So this is not boding well for earnings growth for the S&P. And you can see that analysts are taking note. This is data that we collect here at Zacks. Remember, we collect estimates from all over the street, from large investment banks to the smaller ones as well. And right now, analysts are at roughly $220 of earnings for the S&P this year. That's down from, $236 a year ago and way down from $243 at the top, which was in April of last year, 2022. And I think that this number is going to continue to get slashed. So we're about to get earnings come in significantly for most of the S&P over the next week or two. I will definitely revisit this chart on my next call because it will be very interesting to see how analysts revise their estimates from this point as we get results of Q4 from across S&P 500 companies here. But I personally do not think that this is the bottom. I think that there is further room for cut given what we are seeing here on the Chicago PMI and given what we're seeing with the leading economic index. So I think this is very bearish for earnings. And this number, I'm personally expecting this to come down to about 210. And that would be just assuming a garden variety recession. But here's what's interesting though. The market seems to be defying all these trends because while we saw quite a sharp drop off, since, the early part of 2022, the overall correction has not been that, it has really not been that steep. And you can see, just doing some technical analysis here, I have on this chart the 50-week moving average as well as the 200-week moving average. And we actually tested that 200-week moving average to perfection. I mean, give or take a few points here, but it, was able to recapture that quite quickly, fairly quickly. This 200-week moving average, in my view, is very important for those of you who want to keep an eye on technicals. I'm personally watching this very, very closely because historically speaking, the 200-week moving average has been very, very solid support for the S&P and NASDAQ, dating back 40 plus years. Every time the 200-week moving average has been tested, the market has bounced back. And that's roughly, I would say, 10 out of the last 13 times. So out of the last 13 bear markets, 10 of them have ended at the 200-week moving average. So if we're in one of those periods, then, this could be the bottom of the market, which would very surprise me. That's still not my expectation, but it's possible that was the bottom because that's what's happened 10 out of the last 13 bear markets. However, the other 3 out of those, 13 have, once they have broken down beyond that 200-week moving average, it's gone down significantly more, from that by an average of about 25%. So this low that we put in mid last year, I believe that was in September of 2022. But whatever that low was, if that low breaks down, then, that's a catalyst for significantly further downside for the market. However, like I said, 10 out of the last 13 bear markets have basically ended at the 200-week moving average. And now we're also seeing the 50-week moving average. Seems like it's providing a little bit of resistance here. So we've had, this counter rally. It failed there. It went back down to the 200-week. We had this counter rally. It failed again at the 50-week. We dipped back, and now it seems to be stalling right at that 50-week. So this is like a sort of a tug of war between bulls and bears here. The bulls are, consistently defending that 200-week, and the bears are, consistently defending the 50-week. So we'll see who wins out. But I think that this is important because a break of either would confirm one side or the other. So if we close, multiple days above, say, 4,000, or, let's give a little bit of slack. So let's just say 40.50. I'm just kind of throwing out rough numbers here. There's nothing magical about these numbers, but just giving it a little bit of slack since sometimes there is a tendency to break above it and then pull right back. So I'm giving it a little bit of slack, but let's just say if the market closes above 40.50 for multiple days, there's a chance that, we might be done, and that's a bottom in the market for now. And the market wants to stage a counter rally. But if it fails at 40.50 or below and, continues to get sold off, then I think that, this bottom is vulnerable. And if it breaks down, then that would be very bearish for the market overall. That's just my 2 cents with regards to technical analysis. And, as far as valuation is concerned, there's a lot of sort of, justification for why it should break down if we are entering recession, because we're trading right now at, almost, slightly over 18 times forward earnings on the S&P. And this is because the market has bounced back with resilience. And at the same time, analysts have slashed their estimates going forward. So we're seeing a divergence here, and that's what's causing the PE multiple to actually expand right now. So if we were to take a sort of average recessionary multiple, which would be 15, and if I am right that the Chicago PMI is telegraphing a decline in S&P earnings this year, I really don't see why we shouldn't be substantially lower at roughly 31.50, which is my target. So that's what I have on this slide right here. So my main takeaways from this presentation, most of it is very similar to what I've been talking about for the last many months. Recession is imminent. Currently, the data suggests that it's going to be of garden variety. So I'm not saying that this is going to be some repeat of 2008 where we're going to have a significant emergency in some sector of the economy that is becoming systemic and a threat to the system overall. I'm not saying any of that. But I think it's going to be of garden variety, kind of like what we saw maybe in 2001, where 2001 was not some, threat to our very existence. All it was the bubble popping and, asset prices reverting back to long-term averages. That triggered about a little bit of unemployment, but not, crazy high. So I think unemployment will rise, not to the levels that we saw in 2008, at least not yet. There's no data to suggest that yet, but maybe to the levels that we saw in 2001. And that was roughly about 7.5%. So again, that's a fairly garden variety, shallow recession. Inflation to cool from current levels. I think it might even go negative by year end. And I think the case is building very strongly that S&P earnings are going to be lower this year than last year. So putting all that together, just assuming a garden variety, recession, which takes us to $210 of earnings. Remember, that's just a 5% decline in earnings year over year. Not much. That would give us $210 in earnings this year. And a 15 multiple, which is very, very modest for a recession. So 210 in earnings and a 15 multiple gets us to 3150. So like I'm saying here, the risk reward is not favorable. I think, just by assuming a very mild recession gets you to, a 20% drawdown from today's levels. And that's just my best guess here. So, I would be a seller of stocks right now. I would not be taking on significant amounts of risk. And just waiting to see what, we get from further data, especially with earnings. So, in a market of uncertainty, this is what the key takeaway here is this is kind of talking our book now. But a market of uncertainty, the method that we recommend is to invest in companies that have secular tailwinds, companies that make critical products and services, companies whose demand does not wax and wane with the business cycle, and therefore have a proven record of consistent earnings growth on strong ROIC, even through recessions. So who are these people, right? So these are the types of companies that we invest in the earnings certain proxy. That's the Zacks earnings certain proxy. Our model portfolio here, you can see exactly how well it does over time. It's had a remarkable track record through recessions in the past. And I think, now is going to be no different. We can see that here. And, I'm proud to announce that we've done quite well in 2022. You can see that our portfolio declined by about 8.25%. You can see that right here. That was the full year total return for the earnings certain portfolio, minus 8.26%. That compares to minus 18% for the S&P 500. So that was a great period of outperformance. And then our other portfolios like the Admiral 30, that's the 30 stock portfolio, did even better. We were only down 4.65% in 2022. That's absolutely remarkable. And these are not companies that, require taking on aggressive growth. These are companies that are time-tested, battle-tested, companies that produce the most consistent earnings growth over multiple business cycles throughout 2008, 2009, throughout the bull market years, throughout the bear market years, throughout Fed rate hike cycles, throughout Fed rate cut cycles. Every type of cycle you can think of over the past 20 years, these companies have, experienced it and continue to grow and compound earnings, just like you see here in this chart. So these are very, very time-tested, businesses. And this is our performance. And the interesting thing, the takeaway here is that it may look like, we're just an inline performer, but this is actually quite bullish because this is taking a defensive stance, right? We're playing defense with this portfolio here. Defense wins championships, as they say. And so we're playing defense, and yet we're keeping up with the market return here, which means that, when there is a significant drawdown in the market, that's when we're going to start to show significant outperformance. And so that's exactly what we saw here in 2022. During a year of a drawdown, we beat the market by almost, 1,000 basis points. So, the great news here is that our picks do well during bull market periods, like we saw for the past 10 years, and yet have less downside risk during bear market years. So over a complete market cycle, we will beat the market. That's our goal. That's our vision, and based on actual results as well as backtested results. So we're very proud of this portfolio, and it's been in inception since April of 2012. So it's had a full 10 years plus of a track record, and these are the actual results that you see here on the screen. So, greater earnings stability and faster earnings growth. This is because, these companies are, just phenomenal capital allocators. They are iconic businesses. Many of them, a lot of them are household names, but some of them are, much lesser known names, but still quite remarkable with how they're able to, navigate their respective ships, through turbulent times here. But you can see how consistent the earnings growth is, as well as faster earnings growth over time. So the question is why would you want to invest in companies like these? This is what you get if you invest in the S&P 500 index. A lot of noise, not much return. These are highly cyclical businesses, great companies, but just deeply cyclical. And so, it doesn't make sense to own them all the time. It makes sense to own them strategically, right? When they're trading at a discount to long-term normalized earnings. But if you're an index investor, who's actually doing that? You're not getting that. If you're just sitting on the S&P 500 index or many other indexes like it, you're just holding on to these companies all the time, and these are basically a drag on the portfolio. As opposed to these kinds of companies, which are the ones that we own in the earnings certain proxy. This is a collection of high quality, very, very consistent capital allocators, companies that grow consistently over time, regardless of where we're at in the business cycle. AmerisourceBergen, perhaps the world's largest pharmaceutical drug distributor, Amgen, Accenture, Ballcorp, many more like that. Just terrific businesses to own. So again, to recap, we have, in our portfolio, higher long-term earnings visibility. These are companies that have higher returns on invested capital, faster growth over time because of that high ROIC. They are low beta stocks inherently. And so we get large outperformance during bear markets, like in 2022. Very slight underperformance during bull markets, but you can see that we've kept up with the market overall. And so once we get a bear market like we did last year, we will show better cumulative and risk-adjusted performance over a complete market cycle. And that's, I think, what we have proven, in this chart right here. So better cumulative risk-adjusted returns over time. So we hope you found this helpful. These are the types of companies we own. Again, just if you were curious as to what kinds of companies we own in the portfolio, iconic businesses, companies that have withstood the test of time, companies that are almost immune to, growth and contraction in the broad, macroeconomy. So hope you found this helpful. Again, we'd love to hear from you if you have any questions or comments or feedback on what topics you want to hear next time. If you're a ZRS client, please email us at zrs@zacks.com. And if you are an advisor tools client, please let us know at zat@zacks.com. All right, thanks everyone, and hope to see you on the next one. Take care. Bye.